Let's bring in one of Stan Druckenmiller's former competitors. Don Steinbrugge has been in the hedge fund world for 26 years, and now he's chairman of Agecroft Partners. That's a global consulting and third-party marketing fund for hedge funds. So, Don, great to have you with us. This story, Bloomberg News' Kathy Burton broke it. Is it a surprise to you?
I think what's a surprise is that he was able to do what he did for so long. Running a hedge fund is extremely stressful. It wears your body down. And the fact he's able to do it for 30 years is remarkable.
What do you think about is it a move that you think other people will be making? I mean, he's been there for 30 years. You know, he's 57. He's got $2.8 billion. It's certainly one you can understand, right?
Yeah, I mean, he's not the first to do this, and he was obviously not doing it for the money. He was doing it because it was something he likes. And to be a successful hedge fund manager, you really have to work 24/7. It's a full-time occupation. You don't take a lot of vacation. You miss out a lot on life. And, you know, most people can only do it so long. So the fact that he did it 30 years is amazing. You know, the issue he's going to have is he's used to going at 100 miles an hour. And once he retires, he's going to have to figure out how he's going to stay busy because he's not used to having a lot of free time. But
I mean, we've been doing a lot of stories lately that have showed that hedge funds don't have the incredible returns compared to the market that they have had in the past, that it's getting harder and harder to make money. We've been hearing guys say this, but you don't think that's the issue here, that we're not going to see a wave of big hedge fund guys step down just because it's too hard to make money in this market?
Well, I do think it's an issue for the largest hedge funds. I mean, what you're having in the hedge fund marketplace today is that most of the growth is being fueled by pension funds. And these pension funds right now have about a 3% allocation to hedge funds. It's probably going to go to 10 to 20% over the next 5 to 10 years. They're trying to replicate, you know, what a lot of the largest endowment funds have done from a performance standpoint. And what they're doing is a lot of them are investing in the largest hedge funds or the brand-known hedge funds. And I think a lot of these hedge funds have too much money, and their, you know, skill set is being diluted over a very large asset base.
Don, let me ask you, one thing that I find is interesting in Kathy Burton's article is that she says, you know, while financial markets have been volatile, he said that's not the reason he's closing his firm. But do you think that played into some of it, that after 30 years of doing it, having a great track record, and still doing fairly well even when the markets were tough, he just got kind of tired, especially in this very tough market environment?
You know, he was running about $10 billion, and doing what he's doing with $10 billion is not an easy thing to do. So I think it definitely had a role in what he's doing. You know, there's some other pretty well-known hedge fund managers that are closing their to new investors, and there's others that have really turned into what I would consider asset accumulators, and they're focused more on generating high revenues than generating strong returns for their clients. And I think, you know, before you invest in a hedge fund, you really have to understand what the capacity is for that particular strategy and make sure you're just not buying brand names.
Let me ask you on that. You know, Agecroft has, as according to my information, 6 hedge funds under management. They have an average size of about $1.5 billion assets under management. Do you think there's a sweet spot for hedge funds?
You know, I think it's different for different type of strategies. You know, some can handle a lot more assets than others, but I think basically the sweet spot is around $200 million to $5 billion. And for most strategies, if you get too far above $5 billion, you start running into difficulty.
All right, hey, Don, thanks so much for joining us. Don Steinbrugge there, chairman of Agecroft Partners.